Peter, we actually really appreciate that you're able to jump on with us today and talk about gold royalty. There's some interesting things going, and I don't know if I'm saying the word correctly, but is it the 𝗙𝗂𝗬𝗓 or 𝗙𝗂𝗬𝗓 project?
The 𝗙𝗂𝗬𝗓 silver project, we acquired a 100% copper stream on the project. They just achieved initial production earlier this year and are ramping up towards commercial production in Q4. But it's a meaningful step change in our revenue profile. The payable silver to gold royalty will be, we expect upwards of £500,000 this year, and then north of £2 million 2025 and onwards. Then that's really just the base case based on Adriatic Metals, the operator at 𝗙𝗂𝗬𝗓, their guidance moving forward. And at $4.50, $5 copper, that's gross revenue north of $10 million a year from the 𝗙𝗂𝗬𝗓 project alone. So very meaningful increase in our revenue profile. And to David's comment, looking ahead, 2024 and 2025, breaking into free cash flow, the recent acquisitions we've done in the last 12 months, the Cozemin royalty, the 𝗙𝗢𝗟𝗓 royalty, and now the 𝗙𝗂𝗬𝗓 copper stream are representing over 50% of our revenue this year and between 30 to 50% of our revenue based on consensus estimates over the next 3 years. So we really made a conscious effort of acquiring cash flowing assets, really supplementing that near-term cash flow profile as our key organic assets are coming online later in the decade. Assets like Ren at Gold Strike, 𝗀𝗏𝗏cy, going to be Canada's largest underground gold mine, but those are assets that are ramping up towards 2028 to 2030, and we've supplemented kind of the bridge between now and then.
Peter, is this a move towards copper in general? Will you look at other copper projects that might come your way?
It's a good question, especially having acquired the Cozemin copper silver royalty and now the 𝗙𝗂𝗬𝗓 copper stream. I think first and foremost for us is always asset quality. These are all first quartile on the cost curve. The technical merits have to be there. And we've consistently said that we will focus on precious metals first and then base metals on the right quality assets to supplement that. We look at copper, zinc, nickel, lead, those LME traded metals. It's where our team has experience and where we have core competency. Where you won't see us diversify is more exotic metals. There isn't a value proposition there, and the lithiums, the rare earths, graphites, the vanadiums, uranium, we love uranium, but that's not our value proposition. Post these acquisitions, we're still over 85% gold focused. We're still very much a gold company, and we'll always maintain that circa 75%, 80% as a minimum precious metals focus. And you've seen that across the sector. As long as you maintain that tilt, you're still somewhat perceived as a precious metals companies in the eyes of investors. To supplement our cash flow profile with some copper is something we're quite excited about.
One thing we do want to touch upon is the recent financing of the $34.5 billion, we believe, financing. But just to swing it in a different direction quickly, there is some recent news on your ESG. We were just curious on what that looks like for you guys.
Just last week, we published our second annual sustainability report and asset handbook. So really striving for best practices in disclosure. We've started outlining our financed emissions within our portfolio. And given we've been focused on these high grade, low cost underground mines, they're also very low in terms of capital intensity. So we've been able to achieve one of the lowest capital intensity portfolios in the royalty and streaming sector as well. Within that report, I think a very important document, especially for larger institutional investors. We're really striving to check all the right boxes and put actual initiatives into practice. Earlier this year, when we did the 𝗙𝗡𝗟𝗓 financing, we also incorporated a sustainability and ESG linked rebate for Aura Minerals, the operator there. So every ounce that's delivered to us or GEO of production, we're providing $30 of contribution so they can make initiatives at the local communities there in Brazil.
Just to interject a little bit, just out of curiosity, as a retail investor, what would that mean for that type of shareholder?
It's a requirement for a lot of investors to see that companies have the appropriate ESG policies in place and that they're committed to sustainability initiatives. And I've heard feedback, you're just kind of pandering on ESG and it's not what's best for investors, but we view it somewhat differently. I think ESG or sustainability encompasses good governance practices, which is something we're very focused on. And ESG, or that social license to operate, is something that we're very concerned about. The old school way of calling ESG is it's just doing the right thing with how you operate. And that's kind of how we think about it as well.
The recent financing, do you want to chat a little bit about that?
Yeah, so the financing was in relation to the 𝗙𝗂𝗬𝗓 acquisition. It had a full use of proceeds going towards funding the acquisition of that stream. And albeit it did increase our share count, incorporating that increased number of shares and looking at the pro forma company with the Varus stream within our portfolio, the acquisition was massively accretive on a cash flow and a revenue per share basis. This was not a financing for general corporate purposes. We have a defined use of proceeds. Really, we're extremely excited to get the Varus asset into our portfolio. Very attractive rates of return. Long life asset, 18 years on reserves alone, only 2/3 of the total resource currently incorporated into that mine plan. And as mentioned, massive immediate cash flow stimulus on the portfolio. So understood some investors were concerned when seeing the bought deal announcement, but we've done a very conscious effort of communicating to the market, speaking with lots of investors over the last few weeks regarding the merits of this acquisition. And given as I mentioned, the cash flow and revenue accretion that it brings to the portfolio, something that really changes the profile of the company.
And also you had mentioned, or rather in a news release, it came out that you'd done a deal with Taurus Mining Royalty Fund. Can you just explain the basics of that deal?
We entered a strategic partnership with Taurus Mining Royalty Fund. Taurus is a private equity group out of Australia, and they've got a team in London as well. And they've traditionally focused on private project financing and building mines, had a lot of success in Africa. This new royalty fund was through a relationship. Actually, our CFO, 𝗙𝗢𝗟𝗄𝗧, knew the team over at Taurus quite well during his stint in Australia. We are looking at co-investing on potential opportunities, but the agreement specifies precious metals opportunities on single assets over $30 million, but we have a good working relationship. Then the other party will share that with them and give them the opportunity to co-invest with us. This helps us expand our reach of opportunity sets. We show opportunities to them, they identify opportunities and bring them into us. So it allows us to collaborate there. But importantly, it allows us to hunt for bigger fish, for bigger game. Taurus has, yeah, go for those bigger streams, and often those have some of the higher quality assets. I think writing at 250 million market cap today, writing a check for 150, $200 million, as you would see with a Franco, a Royal, or a Wheaton, would frankly be too large for us. But by partnering with Taurus, we're able to go and get a portion of those high quality large scale assets with them bringing in a portion of the capital. It's quite attractive for multiple reasons in that way. And then finally, given that Taurus is a fixed term fund, we also have a right of first offer on any opportunities that we pursue together. So if Taurus looks to monetize these royalties in the future, we'll be first in line.
Going in terms of the market outlook, how does Gold Royalty view the current conditions for gold, copper, and other precious metals?
While we're encouraged by where the commodity is now, gold still holding above $2,300 an ounce, copper well above $4 a pound. It's been frustrating to see how the equities have reacted. There's been little to no reaction on whether that's a small cap precious metals company or even the largest precious metals companies, the Newmonts, the Barricks of the world. Largely, we attribute this to the impacts of inflation. And while headline figures have stated that this is stabilizing, we view CPI as not being representative of the reality of inflation on the ground. We think inflation is still well above double digits. If you incorporate housing costs, food costs, they're still rising quarter over quarter. And there's no capacity for central banks to reduce that. So all that being said, we're massively bullish on gold to continue to achieve real all-time highs. And that will ultimately trickle down to the equities eventually. But why we are so bullish as a royalty and streaming company is that insulation from inflation that we benefit from. And I think it's really only a matter of time until that benefit is truly realized.
What happens, say, if gold went from where it is today, call it 2,300, although moving around, and it went to 3,000 and copper to $6? What would the effect be, or how could you explain it to retail investors, what that would mean to Gold Royalty?
It's a good question, because the argument you get with an operator is, okay, we've got operating costs of, let's call it $1,000 an ounce simply, and gold's at 2,000. So we're making $1,000 an ounce that we produce. And then if gold goes up, we have that operating leverage. The percentage change is higher. At a royalty and streaming company, we have top line revenue. So we have a linear relationship to how the gold or the copper price moves. If gold goes to $3,000 an ounce, it goes up 25%, then our revenue should go up 25% associated with the gold price. But where we see the real torque and the real leverage in a royalty and streaming company is the optionality in the portfolio. We have 240 royalties. When gold hits $3,000 an ounce, it doesn't just help our revenue, it helps all of our operating companies invest into the ground, invest into the exploration assets we have in our portfolio. Right now, we have a lot of high quality royalties, but unfortunately, they're being advanced by some undercapitalized early stage explorers. Not our core royalties, not 𝗀𝗁𝗟𝗃, Canadian Malartic, Varus. These are producers, they're well capitalized. But some of the earlier stage assets, when you see that uptick in the gold price, when you see capital start to flow back into the earlier stage companies, that starts to flow into the ground. It results in increased drilling, increased exploration spend. And all that exploration investment benefits a royalty and streaming company at no cost. We don't pay for any of the drilling. We don't pay for any of that exploration investment. So while the immediate impact on the top line revenue has a linear relationship to gold, it's that second order effect that we see within the exploration portfolio that really provides the torque, that exploration ETF that we like to call it within the gold royalty portfolio investors benefit from.
I want to just go backwards on one other thing, but thanks for explaining that. That's an important concept for the retail investor buying into a royalty company to understand how the leverage is incredibly interesting, the equation. But back in, I don't know, middle May, you guys announced record total revenue, land agreement proceeds, and interest in GEOs. Could you just briefly explain that?
That's our adjusted revenue line to capture the total revenue we achieved in Q1. So we had 4.2 million in total revenue, land agreement proceeds, and interest. 4.2 million. This translates into a gold equivalent ounce of just north of 2,000 gold equivalent ounces, as you mentioned. And we provide our guidance in terms of not only revenue, but in gold equivalent ounces to give investors an idea of what is the actual production associated with this portfolio and give you a proxy moving forward to, this is our guidance for revenue, this is our guidance for GEOs, but is gold going to $3,000 per ounce? Okay, what is the forecast revenue and pick your gold price. So that's why we provide the metrics on both basis. Q1 was quite strong as we had some big one-time payments from our royalty generation arm. We do see a big uptick in the second half of the year to achieve our updated guidance of $13 to $14 million as 𝗀𝗁𝗟𝗃 enters production and Varus achieves commercial production as well. So those will be big drivers in the back half of the year.
Exciting year coming, exciting next half of the year.
Absolutely. And then beyond that, we see a full year of production from those assets in 25. Assets like 𝗀𝗢𝗟𝗄𝗏 entering production early 2025. So quarter over quarter, we've got new catalysts coming online with the portfolio.
Seeking the inside track on gold royalty? Look no further than 𝗀𝗍𝗍𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏 real-time stock updates. Visit for the insights and stay for the gains. Seize the opportunity and explore the magic at mindstalkers.com. Uncover new investment possibilities today. Don't forget to like, subscribe, and share this video. Let's get the word out there.